Hey traders, what if I told you there's a powerful candlestick formation that can signal precisely when a price reversal is about to take place? This specific candlestick setup has been shown to consistently appear just before the market shifts direction. In this video, I'll break down what this candlestick formation looks like and how to leverage it for substantial gains. But before we dive in, make sure to hit that like button and subscribe to the channel if you're interested in getting more valuable trading content like this, absolutely free. See you right after the intro and disclaimer. So the specific candlestick setup I'm referring to in this video is known as the pin bar. Now, what exactly is a pin bar? A pin bar is a type of candlestick formation that meets a couple of clear conditions. First, it must feature a relatively small real body. Second, it needs to show a noticeable long wick extending from one side. This prominent wick is commonly called the tail of the pin bar. In some versions of the pin bar, you might also spot a shorter wick on the opposite end, which is often labeled the nose of the pin bar. However, there are also valid pin bars that don't include a nose at all, and that's completely acceptable. So once again, the two main characteristics that define a valid pin bar are 1. A relatively small body, and 2. A long wick extending from a single direction. Now, you may be wondering, why does the formation of a pin bar often indicate an upcoming reversal in price? The reason lies in the fact that this candlestick is a strong signal of rejection. Let me give you a visual example to explain it further. In this example, we observed a strong upward push as buyers drove the price all the way to the peak of the candle. However, before the candle could close, sellers stepped in and pulled the price back down, effectively rejecting that earlier bullish momentum. As a result, the candle ended up with a small real body and a long wick pointing upward, which, as we've discussed, is identified as a pin bar. This is exactly why pin bars are often seen as early indicators of a possible trend reversal. They reflect a shift in momentum in the opposite direction. And as you'll notice, right after this pin bar formed, the trend flipped and started moving downward. That said, while a pin bar often points to a reversal, it's not a guaranteed outcome. In trading, no strategy is foolproof. There's always an element of risk, which is why proper risk management is absolutely essential with every trade. It's the key to protecting your account from significant losses. Now let's move forward. There are two main types of pin bar formations, the bullish pin bar and the bearish pin bar. A bullish pin bar suggests that the market is likely to shift upward, while a bearish pin bar indicates a potential move downward. The way to tell the difference between the two lies in the location of the tail. If the tail is positioned beneath the body of the candle, then it's classified as a bullish pin bar. On the other hand, if the tail is found above the candle's body, then it's identified as a bearish pin bar. One frequent mistake I see traders make is that they rely on the color of the candle instead. Don't fall into that trap. The color of the pin bar does not determine its type. A bullish pin bar can appear as either a green or a red candle, and the same applies to a bearish pin bar. What truly defines them is the position of the tail. Why? Because the tail reflects the direction of the rejection. When the tail extends downward, it signals that sellers pushed the price lower, but buyers stepped in, pushed back, and drove the price up before the candle closed, making it a bullish signal, even if the candle is red. Conversely, when the tail stretches upward, it shows that buyers initially drove the price higher, but sellers rejected that move and pulled the price back down, signaling bearish momentum, even if the candle happens to be green. Now let's move on to how you can actually place trades using the pin bar strategy. One common error that many traders make is assuming that a reversal will happen simply because a pin bar has formed. Keep in mind, the market doesn't just change direction based on a single candlestick alone. There must be other supporting elements in play. To make this clearer, I'll walk you through two very different pin bar scenarios. First, let's take a look at setup number 1. In this chart, we observe the price trending downward before a bullish pin bar appears. Typically, the emergence of a bullish pin bar implies a possible shift to the upside. But in this case, instead of reversing, the price keeps dropping, meaning the pin bar didn't influence the market at all in this situation. Now let's compare that to setup number 2. Here again, the price declines and a bullish pin bar forms. But this time, the market reacts. The trend actually reverses and moves upward. So what's the difference between setup 1 and setup 2? They both showed bullish pin bars, yet only one resulted in a reversal. Why? The answer lies in the quality of the trade. Setup 1 is what I refer to as a low-quality pin bar scenario, whereas Setup 2 qualifies as a high-quality pin bar setup. And here's why that distinction matters. Setup number 1 is what I classify as a low-quality pin bar setup, while setup number 2 falls under what I call a high-quality pin bar setup. Let me explain the difference between the two. The reason setup 1 is considered low quality is because the pin bar appeared in isolation. There were no additional factors backing it up, which means the likelihood of a reversal taking place is reduced. A single candlestick pattern on its own is usually not enough to serve as a strong reversal signal. That said, keep in mind the key phrase here is lower probability. A reversal might still happen, but it's less likely. Now let's contrast that with setup number 2. This one is labeled a high-quality setup because if you observe closely, the pin bar formed as the price reached a key support zone. Historically, this level had already acted as an area of rejection, which increases the odds of it being respected again. So instead of just relying on a candlestick signal, we now have an extra layer of confirmation from market structure. With the pin bar forming right at a known support area, the probability of a reversal becomes much stronger. These high-probability setups are exactly what we should be targeting when planning a trade. Now I'm going to share a simple technique that helps you consistently identify high-quality pin bar setups. Step 1 is to locate a key price level. Let's examine an example. Looking to the left, we notice that price moved up and then reversed downward, establishing this area as a resistance level. Next, as price returns to test this resistance zone, we see the formation of a bearish pin bar. This is considered bearish because the long tail extends from the top of the candle. Initially, buyers pushed price higher, but then sellers entered, driving price back down before the candle closed, indicating strong rejection from above. That's why the wick is visible at the top. So, we now have three critical elements aligned. First, we know this resistance level caused rejection previously, meaning there's a higher probability it will again. Second, the current price is testing that same resistance level. Third, a bearish pin bar has appeared, signaling downward pressure due to rejection from higher levels. Combined, these signs point to a strong setup for a short trade. For risk control, you can place your stop loss above the wick, and target a profit that is around 3 times the size of your stop. As shown here, this resulted in a solid profit from the downward move. Let's look at another scenario. Again, step 1 is finding a key level. In this chart, we observe that price advanced, touched a level, and fell, marking this zone as resistance. Later, price moved up again and broke above that resistance, which now flips into a support level. Soon after, price dipped back down to test this new support zone and formed a bullish pin bar. Once more, the candle features a small body and a tail extending downward, signaling rejection from below. If you look more carefully, you'll also notice another significant level, a rising trend line that's been tested multiple times in the past. This intersection of the horizontal support and the trend line is what's known as a level of confluence. When price is sitting at such a point, the probability of a reaction is significantly higher. So now we have two confirming elements. Price is at a confluence zone, and a bullish pin bar has formed at that location. This gives us strong grounds to take a long trade. For risk management, place your stop at the tip of the lower wick and aim for a reward that's 2 to 3 times your stop. As you can see here, this trade resulted in a profitable move upward. But a word of caution, these setups are not foolproof. Even high-quality entries can fail. Trading is built on probabilities, not certainties. So never bet everything on a single trade, and always apply sound risk management practices like the ones I've just explained. Now let's look at more examples of these high-quality setups. So we now know this resistance level caused rejection previously, meaning there's a higher probability it will again. The current price is testing that same resistance level. A bearish pin bar has appeared, signaling downward pressure due to rejection from higher levels. Combined, these signs point to a strong setup for a short trade. For risk control, you can place your stop loss above the wick, and target a profit that is around 3 times the size of your stop. As shown here, this resulted in a solid profit from the downward move. Next, as price returns to test this resistance zone, we see the formation of a bearish pin bar. This is considered bearish because the long tail extends from the top of the candle. Initially, buyers pushed price higher, but then sellers entered, driving price back down before the candle closed, indicating strong rejection from above. For risk control, you can place your stop loss above the wick and target a profit that is around 3 times the size of your stop. As shown here, this resulted in a solid profit from the downward move. Let's look at another scenario. Again, step 1 is finding a key level. In this chart, we observe that price advanced, touched a level, and fell, marking this zone as resistance. Later, price moved up again and broke above that resistance, which now flips into a support level. Soon after, price dipped back down to test this new support zone and formed a bearish pin bar. Once more, the candle features a small body and a tail extending downward, signaling rejection from below. If you look more carefully, you'll also notice another significant level, a rising trend line that's been tested multiple times in the past. To wrap it up, the pin bar pattern is a highly useful strategy to learn, as it allows you to spot areas of rejection in the market with precision. But once again, never rely solely on the pin bar signal. Always combine it with other forms of confirmation, such as support and resistance zones, to boost the accuracy and reliability of your trade setups. That's all for now, traders. Thanks for tuning into this video. I hope you found this video helpful and packed with value. If you enjoyed it, make sure to tap the like button and subscribe if you're new to the channel. Don't forget to enable notifications so you never miss our latest uploads. We'd love to hear your thoughts and ideas. Drop a comment below and let us know what topics you'd like us to cover next. Your support means a lot, and we can't wait to see you in the next video.